Welcome to your 2021 UMPIP webinar to achieve your retirement goals. Today's topic is focused on the United Methodist Personal Investment Plan. I am Cheryl Hatcher, a team member of Wespath Benefit Plans Department. It is my pleasure to moderate this webinar. Please know that we will be recording the webinar and I will be keeping everyone on mute. As soon as the link to the recording is available, I will send it out to you via email. Due to the amount of information that will be imparted to this large group of people within the next hour, we will answer as many questions as possible that are added to the questions pane at the end of the webinar and during the webinar. Otherwise, the Participant Solution Center is always available to answer any specific questions relating to your particular situation. Now to get started with the webinar, it is my honor to introduce you today to today's distinguished speakers. All of them are thoughtful and knowledgeable employees of Wespath who take pride in helping United Methodist clergy and laity understand the intricacies of the benefit plans they have through Wespath. Your incredible team consists of benefit educators Todd Creviston from Montgomery, Illinois, Frank O'Brien from Long Island, New York, as well as the manager of benefit education, Robert Christoffel, also from Long Island, New York. Please bear with us in this technology while we switch amongst the presenters. So it is now my pleasure to turn the presentation over to Todd Creviston.
Hello, everyone. Thank you for joining us today. Before we get started, I wanted to point out a couple of things on the GoToWebinar control panel. And everyone should see that control panel. Up along the top, it says File Options, Review, and Help. And then down below, you'll see a bunch of titles. And what I wanted to call out was two areas. The Questions tab, or the question title, you can click on it and expand that section. And that's where you can go ahead and type in your question as we go through the presentation today. And we'll do our best to answer those back to you as the webinar unfolds. The other section is right below that. That's the handouts, and you'll see the number 5 right next to it. So we've preloaded 5 handouts for you. That's UMPIP at a glance. It's a great overview. That's available to lay and clergy. CRSP at a glance. That's a clergy program. Life Stage Suite, Solution Suite. We'll talk more about that during today's presentation. EY Financial Planning is also a wonderful resource, and then the contribution election form for UMPIP. So you can go ahead and click on those and download those and definitely use those resources. So today is the second of our UMPIP series for 2021. We like to begin with just providing an overview of who Wespath Benefits and Investment is and what we do. So Wespath is a not-for-profit agency of the United Methodist Church. We're actually located in Glenview, Illinois, and that picture to the right there on the slide is actually a picture of the building we moved into in 2010. So we've been there for quite some time. However, we also all haven't been there in quite some time due to COVID. And we're eagerly looking forward to getting back into that building later this summer. So Wespath manages about $29 billion in assets. That is a huge responsibility, and we take that very seriously. We also take all of our participants very seriously as well, and they're very important to us. There's approximately 100,000 participants in the different plans. That includes active clergy and laity. That also includes retirees and surviving spouses. So what gets us out of bed each day is that mission statement at the bottom. And it's caring for those who serve by providing investment and benefit services that honor the mission and principles of the United Methodist Church. So a quick snapshot on who Wespath Benefits Investments is. Now let's talk about the 2020 webinar series. So the quarterly UMPIP webinars are designed this year to focus on a particular aspect of UMPIP. In Q1, the focus was on explaining what UMPIP is, how to enroll, how to contribute, the different ways of contributing. If you weren't able to join us for that webinar, it is available on wespath.org, and you're able to view that at your leisure. In Q2, which is where we are today, we'll review how to invest in Wespath by participating in UMPIP. The Q3 webinar, the date has already been decided. It's Wednesday, September 22nd at 1 p.m. Central. We'll send you an email reminding you of that, and we hope that you also attend that webinar. The focus for the Q3 webinar will be on accessing your money. Life happens. So as you contribute, there are ways to potentially take a distribution, in addition to taking a distribution as a retiree, which of course is the ultimate goal. And then in December, Q4, that's about planning for the future. A little bit more information on today. We'll cover the types of contributions, the Wespath funds, the different funds that are available, explain what life stage investment management is and what it does and how it can help you. And we'll conclude with the tools and resources and education materials that you have available or that are available to you. And I should say, there's no shortage of resources and tools. And we'll definitely cover those as we go. Now I'll turn the presentation over to Frank, and he will continue with the presentation.
Good afternoon, everyone. My name is Frank O'Brien. I'm a benefits educator here at Wespath, and as you heard, I am out on Long Island with Bob Christoffel. I'm not quite sure if you've had a chance to transfer that. Here we go. So, Todd, we can see my screen and everything is in good order?
Looks great.
Thank you very much. So what is UMPIP, the United Methodist Personal Investment Plan? Well, it is a defined contribution 403B plan. It is a qualified retirement plan, which means it's a part of U.S. law and it's accepted by the IRS as a vehicle that can accept retirement contributions and allow tax deferrals on contribution types and earnings in the plan, amongst other things. It is an account balance plan. Contribution dollars, your contribution dollars, and in some instances, employer contribution dollars are going into the plan, invested in the funds that you choose. That account balance is there for you to see on your statements and grow over time. It is a participant-driven plan. However, in many instances, your employer or plan sponsor may be providing employer contributions for you, either non-matching contributions of a certain percentage or have a matching contribution formula that matches up to the amount of money you're putting into the plan. We have participant-directed investments. You're going to hear about the Wespath family of funds as we go through the presentation. With this type of plans, you have options and you have choice. Options include the contribution account types that I'm going to review, the investment funds and how you want to structure your investments in the plans, and other options in terms of later on going into retirement, how you want to take monies out of the plan in retirement, and again, amongst other things. It's defined and regulated. Again, qualified, defined, IRS, US law. You're going to hear about the contribution limits that are defined every year, defined contribution plan, and it's regulated. Under what circumstances can you contribute? How much? Under what circumstances can you take withdrawals? How, when, how much, and why? And we also have a loan provision that you'll hear about in the September webinar. How can you access your accounts for loans? So they're defined and they're regulated, but you do have plenty of options and choice. Today's focus is on the participant contributions, the participant contribution accounts. You decide how much you want to contribute. And in that parentheses, you can see you can decide on a percentage basis or a dollar basis. We consider it a best practice for all of us to elect our contributions on a percentage basis, simply because hopefully over time we're getting wage increases. And if your cash flow is such that you really can't increase the amount that you're putting in the plan, but you get a wage increase and you're using a percentage, well, the dollar amount's going to go along for the ride in terms of the increase relative to that percentage. So if you're doing dollars, think about doing percentage. We're going to talk about the account types, and Bob Christoffel will go through how it's invested, self-managing, and life stage investment management. We have these participant contribution accounts. You can see the after-tax, before-tax, Roth, and then rollovers. The rollover account is actually the last I'm going to speak about as I complete my segment. But for now, we're going to talk about the before-tax and Roth primarily. We'll hit on the after-tax as well later on in the presentation. And the reason for that is the tax advantages that you receive by contributing to these types of accounts. If you choose a before-tax contribution or salary reduction contribution, you are avoiding taxes now on those dollars going into the plan. However, if you choose a Roth account, then you can avoid taxes later by paying taxes in effect now on those amounts, and then later on, under certain conditions I will review, be able to take those dollars out in retirement and not pay any taxes on those distributions. So a little bit more on the before tax. You avoid taxes now. The contributions and earnings are tax deferred, so the contribution amount goes in. The earnings that you receive on that also tax deferred. All of that exposed to taxation on the way out in distributions. But for now, no federal or state income taxes are applied until you begin to take those dollars out in retirement. The Roth contribution account, you avoid taxes later. And I'm going to give you an example of this. You pay taxes now on the contributions that are going in, or on your pay, you pay taxes and the contributions go in. And under certain conditions, if it's a qualified Roth account, you do not pay any taxes later on in retirement taking distributions. And to qualify the Roth account is actually fairly straightforward. First of all, the account has to be 5 years old. So that first contribution that goes into the Roth account has to be 5 years old or older. Not every contribution and not every year's contribution on a rolling basis, just that first contribution attains age 5 is 5 years or older. And the second is that you have attained age 59 and a half. So you're 59 and a half or older, that account is older than 5 years, you can begin to take distributions from your Roth account tax-free. Great, a great tax advantage for you. To think about these two contribution accounts from a tax efficiency strategy perspective, we have some tables to review with you. We're going to talk about gross pay. For today's purposes, for no particular reason, we're thinking about lay employees. So there's the FICA tax or Social Security tax. Then we're going to see the 403B before tax or that Roth contribution. We'll see where the federal tax comes in and what your net paycheck turns out to be. The first example, we have the before tax savings. We have an individual who's getting $2,083 on a monthly basis. It's a lay employee, Social Security or FICA is being paid out. Then we calculate the before tax contribution, that 166 that you see. The net amount after that is what gets federally taxed, and you can see what you would bring home. Here is a Roth savings. You have that same gross amount. You're still giving to FICA or Social Security that 159, but from there we're calculating the amount of federal taxes due. We're putting that, you're taking that out, and then we're still using the same dollar amount, the Roth contribution amount, as the before tax, that 166, and putting it into the plan. The net effect on what your take-home pay is you are taking home $20 less than if you were using the before tax. But again, the way the IRS is looking at this is, well, you've paid that taxes now, you're taking less home now, so later on, time value of money, which is a concept I'm going to review shortly, later on that money can come out tax-free. So you can kind of see how the relationship between the two types of contributions come through, what the net effect is on your take-home pay, and then future opportunities for tax efficiency planning later on. The last example we have is someone who, for very good reason, may not be able to be contributing to the UMPIP right now. And so you have the amount, you have the FICA or Social Security amount, you have the federal amount, but no contributions. So you can see that this individual on a take-home pay basis is bringing home $146 more a month, but has not yet had the opportunity to begin to contribute for retirement. And as you can imagine, part of today's webinar and what we do for a living is to encourage people to contribute towards their retirement as much as they can over time, increasing that amount over time. Again, this is a defined contribution plan regulated by the IRS and US law. So part of that is how much are we permitted to contribute on an annual basis. On this chart, you can see that for the before tax and Roth, this is the tax advantaged accounts, you can contribute $19,500. If you've attained age 50, you have a $6,500 catch-up contribution that is available to you. You can contribute either before tax, Roth, or both. But if you're doing both, it's still the $19,500 or the $6,500. The IRS also steps in and says if the employer is contributing to your retirement, we put a cap on how much that can be. It's no more than 100% of your plan compensation or $58,000. Each year, depending upon the rate of inflation in our economy, the amounts will go up indexed with inflation. So over time, you see those amounts going up. Hopefully you're getting the plan compensation increase, you're contributing more and getting more out of the plan. You can change your contribution type at any time, as it indicates there. If you go into a Roth and you want to go out to before tax or vice versa, you're able to do that. As I began to talk about the contribution types, we had that after tax right there in the lower left-hand side. Back when the 401k first came rolling out, the dollars you could contribute were pretty low. Now they're more generous. So right now, this after-tax contribution bucket is really for individuals who have the opportunity, as a household or individually, to max out that $19,500 and still have the ability to put more money into the UMPIP. They would do that on an after-tax basis. So all the taxation is done, calculation is done, dollars go in. Contribution dollars never get taxed again. They don't get taxed again in distributions, but any earnings on those contribution dollars do get taxed in retirement as you receive your income. So now that we have looked at the various contribution account types, I'd like to spend the next several minutes just discussing certain retirement savings ideas or concepts that are some of the foundations to saving in a retirement plan, such as the UMPIP. So I'm going to speak to things known as dollar cost averaging, the time value of money, a thing called the rule of 72, touch on inflation and the impact and the thinking around inflation. The idea behind dollar cost averaging is the continuous nature of contributing into a retirement plan through payroll. As you continue to contribute to a plan, you are buying fund shares or units of the fund or funds in which you have elected to invest in your retirement plan. On this slide, you can see that the blue line shows the share price going up and down over time. And as you're contributing to the plan, the amount of shares or units that you're buying in the mutual funds also go along for that ride. If the price goes high, the amount of shares that you can buy are low. If the price goes low, then the amount of shares you can buy in that payroll frequency cycle is high. So you can see the relationship or the correlation between the price and the shares purchased. Looking at this example where you've contributed per month, you can see that a different amount of shares gets purchased each month. Studies show that with a dollar cost averaging, you end up purchasing more shares over time, and historically speaking, again, past performance is not guaranteed future results, but historically speaking, the experience is you will get a higher rate of return or a bigger spread on the earnings that you're going to experience in that fund by spreading out your contribution frequency, thereby spreading out the amounts that you're putting in over a period of time, again, through something like your payroll. This is in contrast to a single investment or contribution into a fund which purchases a set amount of shares, and that number of shares is fixed. Again, history tells us that that will still go up over time. That's what history tells us. But with the dollar cost averaging monthly contribution approach, the studies in history also tell us that you can potentially garner more earnings over time by taking this dollar cost averaging approach to contributing into a retirement plan. The next topic to speak about is the idea of the time value of money, or compounding as we've heard of it. I think something we are familiar with. These next slides illustrate what account growth over time may look like under certain conditions. In the box on the right-hand side, you can see an example of a participant's age and amount of planned compensation. At age 25, this individual has $35,000 compensation. Age 45, $65,000 compensation. For our model, we're assuming an annual plan compensation growth of 3% and annual investment growth of 7%. An individual who contributes 1% of their plan compensation beginning at age 25 would see that amount available in retirement at age 65 of about $102,000. If that same individual was to contribute 4% of their compensation over that same time period, in retirement, they would have an amount available in our example of around $409,000. And if the circumstance for that individual was such that they could not begin to contribute until age 45, and their contribution amount is now 6% to catch up on prior years of contributions not being made, the amount available for retirement is around $201,000. So there are a few things to look at with this final slide. You can see that over time, the amount in your account will grow. It does not depend necessarily upon when you begin contributing or how much you can contribute at any point in time. Yet, it can be seen the more you can contribute and the earlier you can contribute, the higher potential account balance may be available to you for and in retirement. But what this slide is not intended to do is to discourage anyone by looking at the age to begin contributing or the amount of the account on the right-hand side. In our view, it does not matter when you begin contributing or how much you contribute. The key is that you contribute. Every dollar available in retirement matters. This next slide is a historical look at domestic U.S. inflation rates. This is a slide that we often use at our pre-retirement or retirement webinars to help future retirees think about the impact of inflation in and through retirement. Financial advisors like EY Financial Planning Services will tell you that there are two risks they look at when doing long-term financial planning. One is taxes, and the other is the impact of inflation. Increases in inflation deteriorate the amount of purchasing power we have over time. In a way, it reduces the amount of real earnings we experience. On the one hand, we have the time value of money just discussed, which increases the amount we have, but with inflation, the value of that money is reduced due to the ever-increasing costs of goods and services. As a simple example, if you are in an investment that's only making 2% and the rate of inflation is 2%, well, then you're not actually making any return because all of that 2% investment return is being taken away by the increase in costs due to inflation. So as you think about investing, taking advantage of the Wespath family of funds you're soon to hear about, you want to be thinking about how you can get a potentially higher rate of return that exceeds inflation. You want to maintain your purchasing power and then some. And as you can see here, that over the course of nearly 200 years, the U.S. inflation rate has been around 2%. And lately, there have been ups and downs along the way that are creating some market volatility because right now it looks like we might be approaching 2% again. Another financial concept that many people actually may not have heard of, but we do come across in the retirement world every once in a while, is known as the Rule of 72. Simply stated, the Rule of 72 deals with the determination of how long a particular investment needs to be invested at a particular expected rate of return for that investment to double in size. And this is an approximation. The math is simply taking 72 and dividing it in by the annual rate of return of the investment that you may have, and the resulting number is the number of years it would take for that investment to double. Again, approximation. So in this example, you can see that $1 invested at a rate of 10% return would take 7.2 years to double to $2. Now, 10% would be considered an aggressive investment. If someone wants to have more of a moderate rate of return, let's say a 6% rate of return in their investment, the number of years it would take to double is approximately 12. And for one who has a conservative investment with a rate of return of, let's say, 3%, then the number of years for that investment to double in size is approximately 24 years. And again, these are approximations, but we think interesting to consider. Now, after spending time discussing dollar cost averaging and the time value of money, why would we bring up the Rule of 72, which is really more of a fixed investment growing over time? Well, one answer is we thought it was something that may be of interest to you, a good thing to be aware of in general. However, a second answer is this leads us into a conversation around the last account balance available to you in UMPIP. If you recall that graphic that I started out with, on the lower right-hand side, there was a rollover account balance circle. You have the ability to roll over prior employer retirement funds or traditional IRA account balances into UMPIP. And by doing so, you then can consolidate all of your retirement assets into the or under the umbrella of the UMPIP plan, take advantage of the Wespath funds, life stage investment management that you're going to hear about. This way, those account balances that are elsewhere, maybe not being tended to as appropriately as they should be, you can bring them into the UMPIP and you can see what's happening with those accounts with each and every quarterly statement that you receive. It's a very simple process. We have an incoming rollover form. Our Wespath staff will work with whoever holds those retirement assets, do a direct rollover into the UMPIP. You never touch those assets. It's a non-taxable event. So something to consider as you're doing some longer-term financial planning around your retirement assets. So as I transition the presentation over to Bob Christoffel, who will review with us in some detail the Wespath family funds and the Life Stage Investment Management Program, I hope I have been somewhat successful in reviewing and explaining the various contribution types available to you and certain tax efficiency strategies to consider. Seeing retirement plan investing in the long-term view, such things as dollar cost averaging and the time value of money, the impact of inflation. And then also we discussed the rule of 72, which is more or less a singular event, but something to consider if you have prior assets you want to roll over into the UMPIP. And then from there, you can take advantage of the funds and the programs you're about to hear about. So with that, thank you very much. And Bob, please take it away.
Thank you, Frank. Some really great information you presented on. I want to thank everybody for joining us on this webinar. It's just awesome to see nearly 300 participants. We're going to go into the investment options section of today's webinar. Now, as Todd had mentioned earlier on, Wespath is a not-for-profit agency that has been serving the United Methodist Church for over 100 years. Wespath invests more than $29 billion in assets on behalf of our over 100,000 participants, including myself, as well as over 130 United Methodist related institutions. Wespath serves not as a proprietor of those assets, but really as a steward of those resources. And as a fiduciary, Wespath acts in the best interest of our investors and our participants, and really makes a conscious effort to manage our investment program in a manner consistent with the principles of the United Methodist Church. We do place a really high priority on providing this professional investment management and implementing best practices that are geared toward achieving long-term positive financial results for our stakeholders. Our investment philosophy is reflected in several key areas: long-term perspective, diversification, active management, and sustainability. What about our participants? That's what I'm most concerned about. What we're trying to do for our participants is provide them with a diversified investment lineup among asset classes, but also we want to provide you with competitive investment rates of return relative to industry averages or benchmarks. All of our investment products have low expense ratios, no sales charges, no commissions, no loads on those investment products. But we also want to provide our participants with meaningful services like life stage investment management, which really is setting your account on autopilot in terms of the investment allocation, and more on life stage investment management in just a few moments. I am also really pleased to announce, really hot off the press this week, we've released our Sustainable Investment Report for 2019 and 2020. And I've had a chance to read through quite a bit of this booklet. It's just got some fantastic stories about our sustainable investment, which really is the foundation of our work to serve the United Methodist Church community. You know, at Wespath, we believe sustainable investment activities will only strengthen our potential to consistently provide strong, long-term financial returns, helping our participants, our stakeholders, achieve their investment objectives. So if you want, if you have a chance, you can just take a picture, scan that barcode there. It'll bring you right to the report. But it's also readily available on our website, wespath.org. So I encourage you, when you have time, to read through that booklet. It highlights some of our investment activities throughout 19 and 20, including our work on climate action, our COVID-19 response, engagements on human rights, and just so much more. So that just came out this week, that report. Now, let's talk about the investment funds in the plan. And this is something that we do like to cover when we do our pre-retirement work. I'm going to go through these investments in a very specific order, from conservative to moderate to more aggressive. And this is the exact same way that they are listed on your quarterly statements. And I'm just going to focus on a few, maybe three things about each investment. I'd like to tell you what category it fits into. I'd like to tell you the goal of the investment. I'd also like to share what security that fund will invest in to achieve that goal on your behalf. And then I'll try to share, if I can think of an interesting feature of each of these funds. So beginning with the safest investment in this capital preservation category. And capital preservation investments include things like money market mutual funds, certificates of deposit. Your bank savings account is designed for safety. That's exactly what your stable value fund is trying to do. It seeks preservation of capital and monthly income. Okay, how is it going to do that? Well, it's going to do that by investing in very high quality with lower risk fixed income securities. What's interesting, and as the name tells you, it's stable. It seeks to maintain a constant unit price of $1 per share. So if you're looking for safety, that would be a match for the stable value fund. The next category, simply called income funds or bond funds, are really trying to give you a higher rate of current income, but also sometimes, like with the Inflation Protection Fund, principal protection from loss of purchasing power due to inflation. So these are bond funds. Bonds are considered to be debt securities. And even within that fixed income category, you can say you have a conservative, a moderate, and a more aggressive bond fund. Now, the Inflation Protection Fund, again, trying to give you a hedge against inflation by investing in bonds, including what's called a Treasury inflation protected security. The fixed income fund itself is a very large, extremely diversified, broadly diversified bond fund, which has many different types of fixed income securities: U.S. Treasuries, U.S. agencies, foreign government bonds, corporate bonds, and mortgage and asset-backed securities. Now, the extended term fixed income fund, again, in this bond category, also seeks high current monthly income while preserving capital, but also providing exposure to you, our participants, to long-term interest rates by investing in this very diversified portfolio of bonds of longer duration. So moving down the list, the next category sometimes is referred to as growth and income funds or balance funds, and it's kind of like the scales there. It has this balance, two different goals it's trying to achieve at the same time, two different types of securities to achieve those two different goals. It will invest in stocks for growth of your principal, growth of your balances, and bonds for steady, consistent income. The multiple asset fund is simply a fund made up of four of the other funds in your core investment lineup. The target is to have 35% in a stock fund called U.S. equity, 30% in another stock fund called international equity, 25% in that very large diversified bond fund we talked about, the fixed income fund, and then 10% in the inflation protection fund. So it's really kind of one-stop shopping. If you're self-managing account, you pick that multiple asset fund, you're going to have exposure to both stocks, equity securities, as well as bonds
debt securities. Then in this last category, often described as growth funds, because that's the goal, to make your balances grow. Also called equity funds. Stocks are considered to be equity securities. You buy a stock, you own a little bit of that company. So you have two quite different, very broadly diversified stock funds. One primarily focuses on US stocks, and the other focuses on foreign or international stocks. They're both very large in terms of assets. They both have a diversified lineup of large, mid, and small size companies, and they both will diversify among many different industries, the international among many different areas of the world. So that really represents your core investment lineup. And if you're self-managing your account, it's among these funds that you would choose. If you're using LifeStage Investment Management, LifeStage will choose among these funds. There are three additional choices called the Social Values Choice Suite of funds. And this is designed for our participants and investors with a heightened focus on corporate, environmental, and social performances. So this suite includes two more fixed income funds and one additional equity or growth or stock fund. This Social Values Choice Suite of funds takes into account concerns expressed in petitions approved by a threshold number of annual conferences. It excludes companies with fossil fuel reserved used for energy purposes, as well as it specifically excludes companies that are subject to annual conference resolutions concerning peace in the Middle East. So additional choices for those that are self-managing your accounts. Additional information, and I always like to go to wespath.org for the daily value of these funds. Frank talked about dollar cost averaging. These are daily valued. Every day your account balances are calculated and updated. You can find those daily values, fund detailed descriptions if you want to know specifically what are some of the holdings in the US equity or the international or what size companies. You can find that on our website. We update our monthly investment performance numbers. You can find that on your website. It's also reported to you on your quarterly statements. I strongly encourage everyone to read their statements, whether it's the paper copy or the electronic copy. You can also find how we stack up against the industry by looking at the benchmark or industry averages, as well as our expense ratios. So just a tremendous amount of information, including that sustainable investment report, can all be found on our website. So I know from experience, having worked for this general agency since 2014, that we have all different types of participants. And I sometimes will ask when I'm doing an on-site event for a show of hands, hey, who is self-managing their own accounts? Who's using LifeStage? Has anybody consulted with EY on asset allocation? Because those are really the three primary ways to do this. If you are comfortable, if you understand the investments, if you understand what your financial goals are and are able to match it up with the goals of these funds, some of our participants are simply self-managing their own accounts. They're choosing investments. Hopefully they're choosing several to diversify to help reduce risk. And then they might be rebalancing as time goes forward, keeping an eye and managing their own accounts. Many of our participants are utilizing LifeStage Investment Management. It takes the burden of self-managing off your shoulders. And I'm going to talk a little bit more about LifeStage Investment Management. But a third way to do this is also important. Consult with EY, Ernst & Young Financial Planners. That's available to our participants at no direct cost. EY can take into account other investments that you might have, what your spouse has in terms of joint accounts, personal investments, retirement accounts. They can take that into account and come up with a suitable asset allocation strategy for you. But let's go into LifeStage Investment Management, which is just such a great service. Why is it a great service? Well, quite frankly, it helps our participants. We realize that you are busy and doing a lot of other important work that you might not have time or desire or inclination to self-manage your account. And what LifeStage does, it comes up with a personalized investment management tool for all your defined contribution accounts. Again, it's putting your account on autopilot. It'll come up with, and when you get your statements, you'll see this pie chart with this asset allocation. You know that old saying, it doesn't put all your eggs in one basket. That helps to reduce risk. Now, there are some important considerations that will affect your asset allocation. Your age is very important. How close are you to retirement? If you are a clergy person, what is your expected commencement date for the MPP, the Ministerial Pension Plan? Also, a very important indicator is what is your risk tolerance? How comfortable are you with investments that fluctuate value on a daily basis? There are 3 different levels of risk tolerance: conservative, moderate, or more aggressive. Will you be eligible for Social Security benefits is an important variable, as well as any other Wespath retirement plans that you might have access to. Those will be used to come up with your fund allocation. Now, once we have that information, we come up with this diversified, customized for each participant approach. We'll set an asset allocation. We don't just stop there. We're going to review this on an ongoing basis. And I think one of the really the best features of LifeStage investment management is this rebalancing of your account when it becomes necessary. It's normal. It's natural for investments to go up and down, to drift from target allocations. So LifeStage is constantly monitoring your accounts and then rebalancing when it's necessary. So you might see, when you look at your quarterly statements, some transaction activity that you did not initiate. Often that would be LifeStage simply rebalancing your accounts. And it's always a pleasure to tell people that, you know, you can use LifeStage during your active service, but also our retirees will utilize LifeStage investment management service. You're free to switch from LifeStage to self-managing. We just think it's such a great service that helps so many of our participants. And this chart is just really an example of a rebalancing. You know, you have this target asset allocation, this diversification among several different funds. And when it experiences a certain amount of drift, LifeStage will come in and then just rebalance it back to the target allocation. Again, I think that's just an important feature of LifeStage investment management. And we do have some handouts on the toolbar specifically about the LifeStage investment management and really the LifeStage suite of services that are available to our participants. A couple of different ways that you can update your profile. I think the easiest way, and the way I do it, is I go into benefits access. Okay, we're going to talk about benefit access. If you haven't registered for that, I would encourage you to do so. You know, Todd is going to talk about some of the tools that are available for you in benefit access. That's the easiest way. You can also call our Participant Solutions Center to indicate what your LifeStage variables are, or you can fill out a form. And I believe we have the form attached to the toolbox as well. If you don't indicate a profile, you're going to default, and that default is going to be to moderate risk tolerance, benefit commencement at age 65, and that we will assume you are eligible for Social Security benefits. So I would rather you go in and indicate your own variables. And if things change, from time to time, you might want to go in and just review your profile and update it as necessary. So that concludes the investment part of today's webinar. Again, I thank you sincerely for joining us. I'm going to jump back into the question box and just turn it right back over to Todd right now.
Hey, thank you, Bob.
Sure thing, Todd. Coming your way.
And Bob, a thumbs up if you could see my screen and it's okay.
I do. I see the participant experience.
Terrific. So there, as I mentioned before, there's no shortage of information or resources about UMPIP and the funds and the investments and the different educational tools. I caution you to not get overwhelmed with that. you can go into Benefits Access as you wish, take a look at a particular area, run a benefit projection, run the retirement readiness tool, and just kind of chip away at it. It's not a website that you need to memorize or look at every day, but it would help to log in. What you see here on the right is a snapshot of the account summary page. The top part where it says plan balances, that's pretty cool. That should look somewhat familiar to you. That looks just like the top section of the quarterly statement. I have mine here in paper. I like to get mine by the US mail. So in Benefits Access, you're able to look at the current account information. I mentioned the benefit projection tools. You could run a benefit projection, which looks at your future account balances. The retirement readiness tool takes into account costs and helps to identify if there's a gap, and then you could look at ways to identify that gap. And then, like for me, I'm plan on retiring at 67. So when I go in and run a projection, I adjust the age to 67, but I may stay and work longer. I might stay until 68, 69. So I can go in and adjust that date and that benefit projection and see how adjusting the date can change what my projection looks like. You can also go in and adjust or update your beneficiary designations. That's important. The beneficiaries that you have on file actually supersede your will. You can also update or change your life stage investment management profile that Bob talked about. And there's a lot of great stuff for you to do in there. So if you haven't registered, please do so soon. I would set maybe 10 to 15 minutes aside and register. And if you haven't logged into your account in a while, please do that soon as well. Just to log in, take a look around and see if there's anything that you need to update or potentially anything that you can learn. I held up my quarterly statement. So here's my quarterly statement. I like to get them in the mail. Your options are to get them in the mail on a quarterly basis or get an email notification saying that your quarterly statement is ready to view in your Benefits Access account. There you could view your current account balance or based on the date that the quarterly statement was run, at the end of the quarter. You can also look at your transaction details. And then if you're not sure if you're in life stage investment management, you can actually flip to page 3 and it will tell you if you're in life stage investment management. So that sentence reads, the investment of your defined contribution account, that's my UMPIP 403B, as Frank had defined, is managed by Life Stage Investment Management Service. So there you have it. I am in Life Stage Investment Management. Picking the funds and the allocations of those funds, it's not my thing. I'd rather provide education and the resources to the participants in the plans than study up and learn how to do all those fine details with my account. So I'm on autopilot. I'm in Life Stage Investment Management. This is a wonderful opportunity as well. This is the EY Financial Planning Services. Wespath partners with EY to provide participants with professional financial planning assistance. This is at no additional cost to you. Wespath pays the fee for EY to provide that service to you. I believe we've had a partnership with EY for about the last 15 years. And what they offer is unlimited confidential telephonic financial planning guidance. You can talk to them about managing debt, whether or not Roth contributions are right for you. You can even talk to them about setting up a budget, setting up a retirement plan. Really, no question is too big or too small. and their information is right there. They're also trained in all of the funds. They're trained in all of the different plans, so whether you're clergy or lay, so they are ready, willing, and eager to answer all of your questions. And again, no question too big, no question too small. Here is the link to the virtual one-on-one consultations with the benefit educator. This would be either with me, Frank, or Bob, and they're private. They typically last 30 minutes. We'll also include this link in the follow-up email, so you can go ahead and register for that. And we typically send a go-to-meeting request. That way we can have a virtual, like a virtual visit. We do secure each call. So we secure each call based on Wespath privacy and security. I mentioned earlier that we take privacy and security and managing those assets very, very seriously. So each call is secured, only takes a couple of minutes, and then it's down to business to answer all your questions. If you have a lot of questions and we don't cover everything in that 30 minutes, by all means, we can set up another consultation. So it's not a one and done. It's kind of as needed, and to take care of your needs and questions. And here is a summary of a couple of the important resources. At the top, Wespath Participant Solutions. That's the phone number. It used to be called customer service. Benefits Access is where you can review your account balance, transactions, contributions, update your life stage investment management profile, and you can also review your account using that mobile app. One more reminder about EY Financial Planning Services listed there. And now some action planning steps or some to-do items. So if you're not enrolled in UMPIP, please do so soon. We know that Social Security won't be enough to replace your working income. So UMPIP is a wonderful plan to help improve your retirement income. You can review your investment strategy. As I mentioned, I'm using Life Stage Investment Management. That selects the funds and the allocations of those funds based on my retirement date and what type of an investor I am. Consider an investment strategy. So because I'm in Life Stage Investment Management, my funds are selected, those allocations are determined based on those that profile. My strategy is to try to get as much of my income into my UMPIP account. So my wife and I have a deal. Every time one of us gets a raise, and sometimes we don't get a raise in a particular year, but we always make sure that we increase our contribution to our retirement plan by 1%. And we always make sure that we do that. Call EY and review your contribution strategy. Take a look at the future date for that webinar. Take a look at placing that on your calendar today. So our next one is September 22 in a couple of months. I believe that's a Wednesday, and it's at 1 p.m. Central. Also consider signing up for that benefit education retirement benefits consultation. The link is there. We hope that you enjoyed today's webinar. We reviewed quite a bit today, but it is definitely doable. Understanding the UMPIP and other retirement benefits is definitely doable. EY can help, the benefit education team can help, and I believe we're all coming back on to potentially ask any last minute or answer any last minute questions.
I want to thank you all so much for participation. There will be a follow-up email coming out to you shortly We'll be converting this to a recording, giving you a link to that recording. We'll also send this out to anybody that registered but could not make the actual event. We've kept a log of the questions, and Frank and I and Todd will be doing some follow-up to those questions as well. We just got a whole bunch of questions came in, which is just great, the interaction that we're able to share with our participants virtually. I know we covered a lot of material. If you do prefer, please sign up for these one-on-one consultations. You don't have to take it down here from the slide. We're going to send that link in the follow-up email as well. So we can really cover a lot of your specific circumstances. You know, everyone's a little bit different. And that way, you know, those consultations are typically 30 minutes, and it's face-to-face like this on a camera. Or if your preference is just to do it over the phone, that's fine too. But it's been a really successful program that we've extended to these UMPIP webinars as well. So again, on behalf of the Benefits Education team, Todd, Frank, and Cheryl, just thank you so much for participation. Thank you so much for your ministry, for what you do every day. And we'll live into our motto, continuing to care for those who serve. Again, this is Bob Christoffel signing off from Long Island. Thank you all for joining us.